Hey everyone, Manny here. I did a video recently on how to maximize your offer in a high interest rate environment, and I made that video kind of around the peak of mortgage interest rates. So I wanted to make another video or a series of videos on how to maximize your mortgage in a declining interest rate environment. Because as interest rates are on the decline, what options do you have when you're shopping for a mortgage? You know, mortgage rates go up, mortgage rates come down, and depending on when you lock, that point in the market is going to be what your interest rate is highly dependent on. Tip number one, the float down. Now, what exactly is a float down? A float down is a way that your lender can go ahead and lock you in at current market rates, and then as interest rates decline at some point in the future, they can renegotiate a rate to try to drop it to a lower interest rate. And what's good about this is it gives you protection on the high side. So if you were to lock in and mortgage rates were to climb, you're still locked in at that rate. But at the same time, if mortgage rates continue to drop, you are also protected because you can also renegotiate the rate to a lower rate. Now, an important part is to go ahead and find a lender that does offer this. You need to ask, whatever lender you're shopping around with, go ahead and ask them like, hey, do you have any float down options? I really like the way somebody put it to me recently. They asked me the question, they said, hey, if I were to lock in today and rates were to continue to drop, what options do I have? And I really liked that question, and I was able to explain to them a float down and what I could do for them. Now, I would kind of caveat that question and ask it a little better, like if I were to lock in today and mortgage rates were to continue to drop, do you have any float down options? If they say yes, I would take it a step further and I would ask them, okay, how many float downs have you done in the last year? Because I think that's an important factor to consider. If they were able to float people down over the last year as interest rates were rising, then there's a high chance that they will also be pretty successful at floating you down as rates are dropping. Now, let's go ahead and let's look at what a float down is, and I'm going to give just a few examples, probably some snippets from websites that will explain it. But like I said before, a float down is just that. It's a way a lender can renegotiate your rate later to bring your interest rate down, and that's important. And I'd say there's quite a few lenders that are willing to do that, because what it does is it keeps the business within the company and it makes the entire mortgage process easier in the long run. Along with that is I would also ask the lender that you're looking at using, what does it cost for the float down? Now, my float downs are free, and well, at least free for the first one. Now, other lenders, and in a Google search I did, not all float downs are free. It may cost you money, and I think that's an important factor to consider as well if you're trying to find a lender and trying to figure out if they will be able to float you down. Is it going to cost you money for that float down? And then an example would be you are buying a house, you went under contract, and then you end up locking in your mortgage interest rate on a 30-day lock because you're closing in about 30 days, and you were to lock it in at 6%. Now, you lock it in now, even though mortgage rates are falling, and in the next, few weeks, they end up falling some more. And so your lender then will be able to, at some point, potentially renegotiate you to, let's say, 5.5% or 5.375%, and hopefully they can knock that out before closing. Usually you want to go ahead and do it, I don't know, like I'd say 10 days before closing at the latest. But it all depends on the scenario and what's going on. Like I said, I do think it's very important that you ask them how many float downs they did, because what I'm finding and what I hear from other people in the market that end up coming over to me or to us is there's a lot of yes men out there that they'll tell you, yeah, hey, we can do this. And a lot of it is for the sake of business, right? They want to bring business in. And I get that, but I think a lot of times you end up with over promises and under deliver. Also with that, a lot of lenders, just because they do have that float down option, doesn't mean that it's an easy thing to do. And I know this because there are like investors that I use that, yes, I can put a loan there and I can try to use them, but it doesn't mean that I will be successful in doing float downs with them. So right now in this market, I have like a group of investors that I use where I place loans for the sake of they have been very good at floating down rates for me in this last year. Like I've done quite a few of them this last year. I'd say about somewhere on 10 of them. And they have been the best ones. So I know going forward, I am going to use them in this declining rate environment because I know that I have successfully floated down rates with them. And I want to be able to offer that up to my borrowers. When it comes to a float down, timing is very important too. Like I said, I can get you like the first one for free, and I'll draft up an example. It's almost like two examples because I did two float downs and they were kind of concentric, happening at the same time. One of them we delayed a little bit. The other one we took what we got earlier, and you'll be able to see the difference in what it made in that time frame. So the first example was because in November we were having the Fed meeting, and so we had two borrowers. They had locked in just before the Fed meeting, and the rationale was we don't know what the Fed meeting is going to do. So it could drop rates, it could increase rates. Both of them were locked with investors that were really good at that I was really successful in floating down rates. One of them was my borrower, the other one was somebody else's. Now, then we'll just call them borrower 1, borrower 2, or A or B or whatever that I draft up on here. So then basically as we locked them before the Fed meeting, and then the Fed meeting happened. Shortly after, rates started to drop. They kind of dropped, they hit a little bit of plateau. I ended up renegotiating the interest rate for one of them at that point because there was speculation that rates wouldn't drop any further. So we took what we could at that point. And then borrower 2, we didn't. So then shortly after that, about a week later, after the Fed meeting, there was a CPI release. And the CPI release was really good for markets, and it dropped rates some more. So on that second drop, a few days after, we ended up renegotiating borrower number 2, and they ended up with a really good interest rate. Then, at that point, I think rates kind of plateaued. They've been kind of sitting in this channel. And so that is the ideal point where you could have renegotiated the rate, and then they have both since closed. So that is like a really good scenario of what it should look like when you're renegotiating a rate and then to closing. And that's what you want to be able to do. You don't want to get stuck at the higher interest rate if you don't have to. And I think that's going to be an important factor kind of going forward. And keep in mind that as rates drop or they continue to drop, I truly believe that home prices and mortgage activity is going to increase. I think there are a lot of people that they were saying that basically when rates were at 5%, 5% is too high, and then they hit 6%, they're like, oh no, 6% is too high, I'm not going to get a house at 6%. And then rates went into the 7s, into the 8s. And so as rates come back down, those that were waiting to buy may go ahead and buy at 6% or 7% or 5%. It may not matter to them as long as it hits a better point for them. And I personally am seeing that more in the market today. There's a lot more mortgage activity now than there has been, I'd say since July. And I think a lot of it is because of pent-up demand to buy a home. And then another thing, do not mix up float down with floating your rate. So a float down is basically you lock in a rate and then rates continue to drop. And then at that point, somewhere in there, you're able to drop that interest rate. Floating rate is you're under contract and you don't lock in a rate and you just kind of let it float with the market, hoping to time a better interest rate lock, because you can lock at any point in the process. That's, as opposed to float downs, I feel like that's a lot more of what people did before to try to get a better rate, is just kind of float their rate and then wait to see and choose a point where they can go ahead and lock in a rate. Because back in 2009, when I bought my first house, I want to say that I had never heard of a float down option. I think it was just more you lock in your rate and you're stuck with what you get. If the market drops, it drops. If the rates increase, they increase. But at least you have the security knowing that you locked in and chose your interest rate. And then also don't mix up float downs with buying discount points or buying down the rate, because that's something completely different. I did another video on like discount points and buying down your rate, so that's something different as well. Just want to thank you again for watching. Please take the time to like the video, subscribe to the channel. It really helps, and I'm hoping to get a better reach and educate people more on just mortgage related things to help our bros out there go ahead and get the best mortgage that's available to them.